Please welcome Chief Growth Officer and Executive Vice President of the Milken Institute, Sarah Sandler.
Welcome, everyone. I hope the last few days have been productive, informative, and engaging. Around the world, we're seeing evidence of disruption and divide. Many of the conversations you're hearing and participating in at the global conference are looking at the world's most pressing challenges. But our ask of you is to focus on opportunities and solutions as we look to achieve our theme of building a flourishing future. The Milken Institute builds community across sectors, both public and private, to address critical issues in finance, health, and philanthropy. It's because of your intellectual and financial capital and participation that we can continue our mission of building meaningful lives. Before we dive into the program, it's my pleasure to formally acknowledge and thank the group of people who make this event and all the great work we do possible, our supporters. So if my research is correct, today we'll hear from a group that manages or allocates nearly $50 trillion in assets. I have no doubt we'll learn something about how to build a flourishing future from them. Please welcome our panel led by Jennifer Prosek, my friend and founding and managing partner of Prosek Partners.
Hi, everybody. 50 trillion, that's a lot of money. We got a lot of money up here. I hope you enjoy this while you're eating your fabulous food. Thank you, panelists, for all being here. You know who the panelists are because I think you've seen their names and titles on the screen. I want to start by talking about what one of the reporters told me they thought the vibe of the conference was so far. And the quote was something like this: it's been a split screen between confidence and unconfidence. So it's kind of been going back and forth. So in that split screen sort of message, I wanted to ask the panelists how they're feeling. And so I was going to ask them to rate how they believe the U.S. economy, the health of the U.S. economy on a 1 to 5 basis, 5 being I'm really quite confident, and 1 being I'm pretty insecure. So who wants to start? Kamal, let's start with you.
Well,
give me your number.
1 being insecure.
Or, or not confident, or we don't think it's going so well, or we think we're nearing recession, whatever way you want to characterize a 1.
I'll probably give you a 2, and the reason I give you a 2 is there's a lot of nervousness with decision makers.
Yeah.
I'm a CEO. I talk to a lot of CEOs, and there's nervousness there.
And you're a CEO of a $700 billion plus asset manager, so
yeah.
I kind of
and I think of decision makers globally, not just U.S., but the U.S. economy is the biggest part of the world economy. But there's also a lot of hope, and so a lot of investors have hope. Decision makers have nervousness. And ultimately, I look to decision makers to be the real signal of the economy.
Okay. 2. All right. Kim Liu.
I'm probably close to Kamal. We're friends. We're going to stay in the same. So, I think it really
Wait, what's your number, Kim?
So my number is maybe 2.5.
Okay.
And I think it's a function, the part of this is a function of whether you're talking about the near term or the long term. In the near term, for sure, just so much insecurity, so much instability. I would say for sure, but do I have confidence in the U.S. economy over the long run? I'd like to think that we're resilient and we know how to self-correct, but it's been a long time since we've had any dislocation. This is a really big dislocation. It's never lost on me how many young people on our teams have never been through a cycle. Mm-hmm. And so I don't necessarily have full confidence that the answers will come quickly. I'm old, and the answers are not coming quickly to me. So I just feel like this is a period of enough uncertainty that I'm not confident about the near term, but I'm eternally confident about the U.S. over the long term.
All right, Kim Liu's a 2, and that rhymes. Tony.
You guys are pessimistic.
Yeah.
I'm a 4.
No one has
All
ever
right.
accused you of that before.
I'm a
flipping
4.
the
Listen, I
script
think
here.
there's certainly uncertainty, and I think we're gonna push through it. I'm optimistic about technology. I'm optimistic about the direction of the economy. I'm optimistic about cutting costs. And so, I think there's a lot of excitement in the world right now, and it's a fantastic time to live.
All right, I'm feeling better. Tony's making me feel better. Rick Rieder.
So I'm going to keep the trend a little bit more enthusiastic here. Listen, I think people underestimate. By the way, I agree with the uncertainty. I agree with the policy dislocation and concern around that. I just think the U.S. economy, take similar to what Tony said, technology, energy independence, better demographic than the rest of the world. You can throw a lot of negative policy influence, and the economy makes its way through it. Watching the last couple of weeks around how the service economy keeps moving along, and the U.S. economy is more of a service-oriented economy. We're going to tariff goods. We're going to create inflation alongside of it. But I just think the service economy. By the way, I'm not a 4 on the markets because I think markets wig out. And I think they are, and agree on the comment that, you look at the illiquidity, the uncertainty, how do you interpret how these things happen and how they play out? But if you said to me, with a little bit of a throw past a month or so, and by the way, I think there's going to see a divot in terms of growth in the next month, but then I think the economy will pull through.
All right, were you a 4? Is that right?
I was a 4.
You're a 4.
Yeah.
All right, Dan.
I'm going to reflect the split case, which is the bull case is definitively a 5. I think in line with something Tony said. If you get through this uncertainty and you get to sort of consistent trade policy or equilibrium, deregulation, innovation, energy prices, the resilience of this economy to what Rick mentioned, and pro sort of commerce, pro-business sort of sentiment in the US. At the same time, Europe and other places stimulating in reaction to that. I think it's something either Tony said, as an investor or as a decision maker, to Kamal's point, this is a pretty interesting time. But the uncertainty does create that other balance. And I think what you're seeing in the markets, to Rick's point, is it's very hard to be short when there is a real 5 out there. And I'm not saying that that 5 is 30% or 20%, but there is a 5. And so even if you have an uncertain view and you're worried about sort of economic environment in the next 6 to 9 months, there is a 5 out there as a possibility.
All right, and Rick, I'm going to go back to you because you are kind of a macro guy, and I saw a video or an interview with you talking about operating in the haze. What did you mean by operating in the haze?
So, I've learned over my career that you don't generate a lot of return and make a lot of money until you have that pit in your stomach. And, when you are certain you're right and the consensus is oriented in the same direction, it usually works for a short period of time, and then everybody ends up getting out. And so I just think, particularly today, I think you always have to operate in the haze. So you think about how technology's changing the world, and I think about where we're going to be 1 year, 2 year, 3 years hence. And anybody who says they know, I think, is just lying. I think today there's an incredible amount that's going to change in the world. And so I believe in this thesis. You try and get, what are you comfortable with? What are you confident is going to happen? And then where you need to take risk. Where are you convex to the upside? I always say with equities, we're trying to create convexity to the upside. Bonds are convex to the downside. I'm just trying to get paid back. On bonds, on equities, I should say, operate where you got to take some risk. You concentrate your risk a bit more, and then try and make, what could happen? What is the art of the creative and the impossible? And then where can you take advantage of it?
All right. Anyone else want to riff on that before we move on? All right. Well, we are lucky to have people with different swim lanes here to some degree. We've got credit. We've got an endowment. We could talk about retirement. We should talk about global, domestic. So I'm going to pick on each one of you for something, and then we'll go back to these all-panel questions. Kamal, let's start with you because you're to my left. You're running a huge global asset manager, but I'm really interested in your focus on retirement.
Yeah.
And you've been very busy incorporating private markets into retirement. What exactly does that mean, and when will we see privates in our 401k plans?
Yeah, it's a big question of the day. Since we are here at the Milken conference, you could just see the vibe is private markets are booming. But the statement I would make is the average retirement investor is just stuck watching it go by. And the reason for that is we don't have a lot of clarity in the world of retirement, which by far is the biggest investable universe. We all come from different spaces of investment management. If you look at the size of the banking industry, you look at the size of the insurance industry, it's much smaller compared to the size of the retirement. Retirement by far is the biggest investable universe. You could put pensions in there, and you could put 401k style investing, and it is the ultimate frontier for investing. And my argument would be private markets are probably not there yet. I think the statistic I've seen is less than 50 basis points of private market exposure exists in DC-style plans all over the world. Where I'm most optimistic is I think we are going to live through an era where we are finding much more equilibrium between public and private markets. I think for the longest time, people invested by the headline, and I think like many of the investors here, a lot of people are learning to invest on valuation. And they don't really care if it's public or private, but they invest on relative value. And I think that argument is going to open up a tremendous opportunity for what will eventually become more access to private markets in retirement. And in my mind, the best way to go there is through some sort of managed structure, like a target date fund. We could talk more about that. But that's going to be the door you'll have to enter to access private markets.
Okay, Dan, it's impossible for me not to wind into you. Morgan Stanley, just tell us the breadth and depth of Morgan Stanley and the wealth channel and what you see in the democratization of alternatives and what Kamal's talking about.
Yeah, and before democratization, this is not so new. If you were a employee at General Motors or Ford and you were in their defined benefit plan, you probably had 20 or 30% exposure to private markets. The defined benefit plan is now gone. DC's replaced it, and I believe, Kamal just said, 0.5%.
Yeah.
So the same family, let's say, working at these companies at two different generations, had very different asset allocation options. At Morgan Stanley, we're about $7.4 trillion, 6 of that in the wealth management channel. We are very bullish around the allocation to the private markets. We think it's really critical, because we're not pure retirement, some of it is retirement, to really be intense around the education on liquidity budget, so that people have the appropriate understanding and consciousness of how much illiquidity they want in their portfolio. But if we get to, let's say, $10 trillion at Morgan Stanley in wealth management, you will be allocating, if our allocation goes from about a current 4% in our channel to 10, $1 trillion allocator to the private markets. Right now, we think we're the largest allocator to private markets in the world, but we could go from 250, 300 to $1 trillion. And I think there's real innovation from a lot of the asset management partners here, including the ones on this panel, to work with us to come up with structures and hybrid elements and semi-liquid vehicles, so that we can work through that democratization. And then, as said earlier, that'll extend, I think, over time into the pure retirement market, 401k, IRA, and then some elements of the
How early in this cycle are we, early or late? Where are we in the progression of this big mega trend?
We've been working on it for a decade, so we've gone from sub 50 billion in private markets in the wealth space to close to 300 billion over a decade. But I think you're seeing acceleration. I think part of that is the breadth of products. It used to be just private equity, and now you've got credit, you've got real estate, you've got infrastructure, you've got various forms of types of hedge funds that you can put in that. So I'd say we're in third or fourth inning in the United States. and the trajectory is high. This is a global conference, so what we're seeing happening in the US is starting to happen in Japan. It's happening in parts of continental Europe, and so the trend line around diversification and finding alpha and relative value wherever you can, we're on that path. And the thing I'll highlight maybe later is, to a degree, the lines are blurring. And so, for example, in credit, we just think about it as credit. If we're selling it as an underwriter to 5 firms or 100 firms, the underlier is still credit. The work still has to be done. And so you'll see some of those distinctions even as we get to the client base in wealth management blurring.
Rick, do you want to comment on this?
100%. So I think the world, I completely agree. I think the world is moving to a place where it doesn't really matter if it's public or private. It's all about cash flow and how the cash flow gets down to whether you're senior, super senior, mezz, equity. What's your cash flow? What is, and then, when we, look at our portfolios, I can do publics, privates, I think about what's my liquidity, what's my VAR, my dispersion, what's my beta, and then the convexity of the asset, and then I just look at it, and quite frankly, whether it's public or private is not terribly, I've got funds that require liquidity, so I got to make sure I manage my liquidity, my illiquidity, but I just think, I completely agree, I think the world is going to move to a place, it's all about cash flow, and what do those cash flows get to you, and quite frankly, I think what's exciting in the world is, think about how the CLO market developed, how the real estate market developed, about efficient financing. Sponsor puts in equity, you've got the mezz, you've got senior, you've got super senior, you've got, where are you on the attachment point? Governments are now going to start financing that way. And I think the concept of infrastructure, how do you finance infrastructure? It used to be governments, they spend, they borrow, they tax. I think in that order. Sometimes it's different. But I think the concept of how the financing markets are going to move into infrastructure, government finance, we'll get to this point about public, private, and how do you do it efficiently, where you can multiply government spending 10 times if you actually do it efficiently versus we spend, we borrow, we tax.
All right, Tony, you made headlines a few months ago. Eldridge has launched an asset manager, but it was a $75 billion asset manager. So obviously you've been at this a long time. Talk to us about why the packaging, the asset manager, and what we should expect from Eldridge.
So just on the liquidity point
Yeah,
that Rick was talking about, right there. I think the aid development right now in the private markets has been secondary activity, and so there is liquidity that's coming into private markets by way of secondary activity, and we've got a fund that we've launched called a GP Solutions Fund, where we're going in and providing liquidity to limited partners and aligning with the GP to be able to buy one of their best assets. And one of the hardest things to do in private equity, I think, right now, is to be able to underwrite and diligence an opportunity over a 3 or 6 month time period. And so rather than selling your crown jewel asset and the asset that's performed the best, why not actually get out there and recapitalize that asset, bring some other cash into it, provide liquidity to limited partners as they look for liquidity. And Eldridge Capital Management is an asset management firm. We've really managed money on our own account. It's small in comparison to my fellow panelists here, 10% of Kamal's to Kamal's size. But we've launched with 4 strategies. We're starting to accept outside capital. We will be the biggest investor in each of our strategies. It's 2 that are focused on credit, pretty broad credit, so diversified credit, which includes asset-based lending, corporate credit, and structured credit, and then real estate credit, where we have about a $4 billion portfolio, and $2 billion of that is drawn right now. And it's construction lending in big gateway cities, where we can get a 9 to an 11% rate of return right now. And then 2 pretty narrowly focused, equity strategies, the GP Solutions, business that I talked about, and then sports and entertainment. We bought the Dodgers back in, 2012. We've been investors in sports and media. We founded a business called A24 in film business, TV and distribution, film and distribution business, and production business. They, won 6 Academy Awards. swept 2 years ago, the Best Picture, Best Director, Best Actor, Best
You're
Supporting
starting to
Actor.
make credit sound fun.
Yeah.
Is that possible? You happen to be actually, you are eating lunch in the same room that the Golden Globes is held, which is also an asset that you're invested in.
Yeah, at the Eldridge Industries. So Eldridge Industries is the holding company. What we do there is to really build and invest in businesses. Eldridge Capital Management and Eldridge Wealth Solutions are the two, asset management and insurance businesses that we have. That's the single biggest asset of Eldridge Industries, and then we've invested in and built businesses like A24, like Metropolis, which is a parking tech company that has got a lot of momentum behind it and a pretty innovative product roadmap. And the Golden Globes is another one that we've now partnered with Jay Penske on.
Now we're going to have to make you go back to credits. That's all the fun you get today.
It's the credit approach that, how do you get your money back?
That actually is a good point.
Yeah.
You've had credit flow through every investment strategy.
Mm-hmm. Yeah, and when A24 started getting into the movie business, they looked at a movie was finished, and they could come up with a marketing plan. And they'll talk about it and say, okay, we're pretty creative marketers. We can leverage social media back when social media was really in more of its infancy. And they could, basically take a B or a B+ movie and turn it into a A- movie from a performance perspective.
Super cool.
Yeah.
Now, we're going to have fun because Kim Liu is here. Kim Liu she's the CEO of the Columbia Investment Corporation, running a $14 billion endowment in today's rocky world of being in universities. We won't touch too much on that, but I will like to ask you, you've had a really good performance. I think I saw some October numbers, up 11%. Congratulations. I'd just like to hear a little bit about the construction of the endowment, but also like if you had the freedom to reconstruct what you're investing in now, what would you be looking at, Kim?
So the numbers, the 11+% performance that you're noting was our last fiscal year. We only give out fiscal year performance, so that's the 630 number. And I think that a lot of that had to do with the fact that we had a really good portfolio construction. Our asset allocation was appropriate for that market, meaning we had a bias towards global equities, which was the best performing asset class, and somewhat underweight to venture, which underperformed during that period of time. So it's both a function of picking good asset allocation and good manager selection within that add a lot of alpha on top of it. But the way that historically foundations and endowments and anyone who's invested in alternatives is that you build the strategic asset allocation and you have to commit to it through cycles. And I think that sometimes that asset allocation works for you and sometimes it's challenging, right? And I think this is a moment where you see the reversal. Not quite yet. We'll see what happens for the rest of the year because
remember, she's a 2.
Right. Remember, I'm a 2. And a lot of what they were saying, I agree with, but also concern me. So we've historically constructed portfolios that allow us to leverage the advantage we have as long-term asset owners. Meaning we know that we don't need all of our capital in any one year. We have a payout. All the foundations and endowments have a payout. They tend to be below 10%, somewhere in the 3 to 7% range. And so most of your assets you don't need. And so we invested in private assets because there was an advantage to locking up that capital. And we would leverage the fact that we could do that and many others couldn't do it to get that illiquidity premium. The more these assets become liquid, the less that's an advantage for us. And we've already seen the fact that there's so much capital that's flown into it, the deals become more competitive. Arguably, the returns could be lower in those asset classes as a result of all that capital. And as a result of there being a lot more liquidity. One of the things that we loved about private assets for sure was the fact it locked in the capital so that people in bad markets couldn't get out, right? Like you wanted the discipline of keeping people in the markets. When these alternatives happen that allow people to be scared, it changes the nature of those asset classes. So it's a concern. And so we're we have to step back and think about whether the portfolio construction over the long term has to change to account for that. And once again, we'll be in the hunt for where there is illiquidity and where others can't play. I think that that's the big thing. But we're also very clear that over the past few years, some of the best companies have stayed private. And so if you really want a diversified portfolio and you want a portfolio that's leveraged to all the different opportunities globally, you have to be in the private markets. And so we'll watch that too. I think how we play it may change. I think we're not going to be operating in lockstep with each other. You'll see people leveraging whatever advantages they have at their institution. Perhaps they have more access to healthcare and perhaps they have more access to technology or global investing. If you ask me right now what I would wish that we had spent more time on, it's clearly global markets. I tell you all the time, if you want to know someone's portfolio construction, look at their benchmark, because that is what dictates how they are going to construct their portfolios. So if someone has MSCI ACWI benchmark, there's not a lot of international in that benchmark. If you have an S&P benchmark, there's not a lot of international in that benchmark. And so those benchmarks of the foundation and endowment community has created a bias towards the US. I think that we all wish that we had looked at the world more globally in this market. I think that I'm not saying that we haven't invested in those markets, we for sure have, but I think that the fact that they are a very small parts of our benchmarks mean that in a world where we're trying to be conservative in how we're spending money, especially right now. People have not done international markets as much as they would have. We came out of COVID, people weren't traveling. Also meant that we weren't going internationally to visit managers to get a better sense of what was going on there. So I think there was a lot of things that led to this being a moment when not as much was done. So
I know Rick wants to say something about riff off you, and so does Kamal. Go ahead.
You were anxious. I'm being provocative. You want to jump in, Rick?
No. Can I say something that I don't think people realize? I think you made a point. So it used to be that the IRR, if it was private, was hundreds of basis points higher. And something happened in the last, I don't know if it's the growth of money that's gone into private credit, but you know how many times this year that something gets auctioned off into the private markets, and I look at the level and say, oh my God, in the public markets, we're getting, and you look at that in real estate where cap rates are versus where we're financing businesses up the stack, it's actually a remarkable transition that because of the explosion of money in the privates, that oftentimes the private trades, certainly on risk-adjusted basis, but oftentimes on an absolute basis, trades actually through the publics today, and I haven't seen that, but the last year it's been pretty extraordinary. Credit, real estate,
and then Dan, because you all want to get in, and I love it. Go
well,
for it.
I was listening very carefully to Kim, and she made such wonderful observations, two very astute ones. One, she said, the results of her excellent performance were, she was sort of long global equities and short venture capital. And the second statement, which was very true, was she believes in a global benchmark. And if you really process that, one of the biases the market has is she was able to say, I don't care about the labels, I see better value here, and I could make this trade-off between a public and private market, and I want to be a global investor. And I think that has been one of the fundamental problems in this marketplace is people do get attached to labels. They do get attached to historical return, not forward-looking valuations. And as Rick said, the world is a lot more fluid at many levels, particularly as Dan said, as the wealth market becomes a more active participant in private markets, I think the dimensions of returns changes. When they were only locked up by institutions, the return series was very much controlled by a certain class of investor. And you have to be open-minded as that expands. It expands opportunity, but it also changes the risk reward.
Dan, you wanted to get in there.
Yeah, I think it's important also to distinguish when we talk about private and public markets that credit and equities are quite different. I think if one of the things we've noticed here at Milken this year is the energy around credit is really quite strong. And I think in a world where financial repression's over, so rates are higher, there's some maybe structural higher elements, so you've got that out there. So it's actually the starting point, at least on a nominal basis, is you get more to be a lender or a credit investor. At the same time, whether it's bank regulation or bank investors sort of putting some constraint on the banks to be part of that, means that asset owners, and Kim is part of this, sovereign wealth funds, but the old Swensen, Harvard asset allocation model had very little credit, right, as an example. And certainly for the last 15 years, you may not have been getting paid for credit as an example, but today you can get credit. So we're seeing, and you're seeing it at the conference, whether it's sovereign wealth funds, endowments, foundations. I'm on the investment committee of an endowment, and a year and a half ago we had zero credit because we had a lot of hedge funds, a lot of private equity, a lot of long equity, a little bit of real estate, and a tiny little credit allocation. And if you can build a portfolio in this day and age around private credit or public credit, actually, any credit, and that's the important message, in the 8-10% range, it all of a sudden becomes a really important part of your portfolio. And so we're seeing just asset owner interest. And for a lot of them, they're going to not do it themselves because they haven't done it historically, and they're going to turn to the asset managers in the room. It's BlackRock or Principal or Eldridge or all the others that are here, Apollo, Blackstone, et cetera, Morgan Stanley. And that is coming to the market. I think that's part of what Rick is seeing, is that the returns are compressing a little bit, but it's back to his original comment, was it's all cash flow. And so it should almost, other than the illiquidity, converge. And then part of the reason it's converging is there's just a much bigger pool of capital focused on credit than we've ever seen. And it's pretty cool to feel it here because Mike was the original, right?
Oh my gosh.
He was the original pioneer in this market, and we're seeing the most recent wave, but we're seeing it in probably the biggest size in our collective careers.
It must be very gratifying for Mike Milken. He's really the father of so many firms that, or inspired so many firms that are here. I mean, credit is clearly the darling of this conference, at least this time around. And right on the stage yesterday, Mark Rowan it was kind of funny. It's sort of an alternative thing to say. He was saying Apollo is completely irrelevant. And what he meant was the market opportunity is so huge that he doesn't even consider Apollo a relevant player because it's so huge. And I'd love to pivot to outside the US on credit. He really talked about the adoption rate outside the US on credit. I mean, Tony, I think you just came from an Asia tour. What's the appetite?
For credit globally,
yeah,
I think it's strong. I mean, for Mark Rowan to say that he's not a global
I know that
player
was very
it's awful.
Yeah,
no one is
self-deprecating.
Right? I mean, come on.
Yes, he's
right.
a good speaker.
Yeah. No, I mean the market opportunity is huge. It's developing over in Asia. I think we'd like to get in the transatlantic credit business. In the U.S., I think it's a great asset class. I think the interesting thing about international investing from my perspective is that, if you think about all the growth that's come in the U.S. equity and in the equity markets generally, I think a lot of it's certainly been innovation here in the United States. And so whether it's the big tech companies or the dynamic capital markets that have really created a fantastic environment for companies and ideas to get funded and people to really pursue ideas and dreams and build businesses. And so, I think the U.S. is a dynamic, economy. Our capital markets are just so much deeper than anywhere else in the world that I wouldn't, want to sell our country short.
No, we're not doing that, but I think there's some opportunity outside the U.S. Why don't we go down the line, just like you talked about, Kim opened this global can of worms up. What excites you outside the U.S.?
Yeah, so Jen, the famous saying, I'll slightly change it, sort of to your question on credit. Credit lies a little bit in the eye of the beholder.
Yeah.
And if you think about the world, the beauty is the world's a pretty diverse place. So I'll pick two geographies we do a lot of business in. So pick a place like Brazil. And Brazil, base rates are 14.5%.
Wow.
That's what the government bond yields. And if you talk to investors, credit investors in Brazil, they're like, why do I have to look anywhere else? And it's a function of economy, so you can't really take the Brazil investor and tell them about US credit rates. They're like, this doesn't make any sense. So I think part of it is the credit markets are driven by what the economy will hold for taking that risk. But I would have never thought China would have the lowest interest rates in Asia. Here's a country that has grown tremendously, yet it's going through a cycle where the rates have asymptotically come down. In fact, China rates are lower than Japan, which most people never predicted would have happened. And if you go to a place like China, they need a lot of credit. They need credit to restart the economy. They need credit to rebalance industries, whether it's real estate or corporates. And so I think the nature of credit is very different in the world. And as we operate, we kind of think of it a little bit in local, regional terms. As I say, we don't like to export US credit to the rest of the world. We want to understand where it is. But it's a beautiful thing because you can apply the same principles and create market opportunity.
Cool. Kim.
So I think, you just always keep in mind that we invest through managers. We don't directly go and buy securities, but we're manager selectors. And, and we're also tend to be very long-term investors because foundations and endowments particularly have fairly small staffs. So when you make a commitment to something, you're trying to commit to it for probably 10 years if possible. We're not going in and out of markets very quickly. So we're looking for markets where we think that there is a potential for outsized returns and differentiated returns over a long period of time. We're looking for a place that has skilled asset managers, right? They have to have skilled security selector. It has to have a rule of law that we can depend on. All of those things made the US so popular, right? And so in this world where arguably there's some erosion of all of those things in the US, you look to see what other markets perhaps have some of those characteristics. It's really hard to find. It's not by accident that it's been hard for us to allocate in some of those areas. That said, we think about which markets perhaps can provide us with some of that. We're going to spend more time looking at India. We do think it's an overvalued market given the conditions at this moment, but we know that that market is changing very rapidly, and trying to look out at what they'll be 10 years from now, it could be significantly different, so we'll spend some time there. We look at the opportunity in Japan, and because of all of the changes in the way the corporations are structured, perhaps there's something there. We do spend a lot of time in Europe because of it tends to have a stronger rule of law, and they do have good quality managers. They can't get out of their way, so it's hard to see that opportunity. Latin America is interesting. We think about in this environment, Latin America, India, and Australia sort of have avoided being right in the middle of the tariff wars, and so there could be opportunities there depending on what the long-term look of trade policies are. We've all said that we wanted to look at Southeast Asia, the problem, small countries, and their independent markets aren't big enough. The biggest independent markets are India and China arguably would be a great diversifier against the US because those countries are decoupling. And so, but we know regulatorily, probably a challenge. So it's hard to get into those markets. So I don't think it's by accident that we've not gone outside of the US with a lot of frequency, but there's a lot on the come. And I do think that because the structure of markets is changing, that we are going to be looking for where there's opportunities as a result of that. So I think that the world is open. We're going to see what happens. I just can't say with confidence that there's any one that I'm like, that's it.
Okay, Rick?
We're going right now.
So I like being a lender in Europe. I generally don't love the equities. And I actually think there's a burgeoning securitization market in Europe and places like Australia that I think are fascinating. You're seeing the banks, how they finance and how they can offload balance sheet risk in, things in Europe like logistics and office and warehouse, et cetera, that there's some pretty exciting things in the securitization market. So I think that's going to grow. I think the world needs that to grow, particularly Europe does, to get any real velocity in those economies. So I think that's pretty exciting. On the equity side, India is a place we spent a ton of time. I agree the market's too expensive. I think it's going to grow, and I think it'll be significant longer term. China's, I think the cheapest stocks in the world sit in China today. How much risk, if the president decides we can't invest in China, so you got to manage that in your VAR analysis. But I actually think some of these big companies in China, and I think arguably some of the greatest technology in many spaces sits in China. How much risk do you take there? Is the question. I'll come back to the, I was just spend 1 second on, things move in cycles and waves, and the movement in the credit, I think, is profound. And I think a lot of it, when I travel around the world, you go to Taiwan, you go to Belgium, and say, what have you been doing? We've been buying mega cap, we've been buying US equities. So if you think about the equity market now, the public equity market in the US trades at what, a 23 multiple of LTM earnings, or 21.5 times forward. So what's your earnings yield on that? 3.5, 3.5? Not that, I still think equities will do fine. But gosh, if you can get, the point you were making, if you can get, you blend the public, private, some of our funds, we create, we're 10%, 15% privates. You can create 7 at a well into investment grade. Pretty good if your return target, if your pension endowment, you return 7, and you can get a 7 at a lower vol threshold. That's pretty interesting today. So I think, more and more, I could see, I've had maybe too many U.S. equities given the currency, and I'll adjust it. But I think, particularly in some of the securitization markets, et cetera, if you can get 7 blended, that's pretty good. 7 to 8, it's pretty good.
Dan or Tony, or
Sure.
should we move
well,
on? Go ahead.
Just as a business matter, because our partners are all the asset managers and asset owners around the world, whereas we're sort of the largest wealth manager in the U.S., but in our securities business and in our investment management business, half the business is outside the U.S. And the U.S. has a really mature and I would say innovative capital market. We can't take that for granted, but some of that is getting adopted around the world. So we've already mentioned India is equitizing. Saudi Arabia, UAE are equitizing. Brazil is equitizing. What's really fascinating is Japan in the last 5 years has equitized. And so the former prime minister would come see many of us in this room, Kishida-san, and he knew more about the 401k market than many people in this room. Yeah. And he really got the regulators, the asset owners, the asset managers, the companies involved, and then led the charge. And in 5 or 6 years, Japan has now really changed corporate governance and changed the attitude towards the markets. And private equity and activists are now embraced rather than rejected. And so you've seen what they've been able to do. And the chancellor was elected, I guess, second round today in Germany, one of your former colleagues. It's fascinating because the prior chancellor, unlike Kishida-san, proudly announced that he had never owned a stock in his life, all right? Whereas the current chancellor worked at BlackRock. Germany, as an example, could equitize, and not just equitize, just take on more risk. It's not just a stimulus call, perhaps, in Germany, but if you have pension reform and retirement reform in Germany, and we move more of that out of the banking system or even the government finance system into both equity and credit markets, it presents a real opportunity for the asset managers here, but it also is critical for that country to fund more of its growth outside the sort of banking government system or relying on the United States for everything. And so, there are opportunities around, I guess, risk-taking and copying the U.S. capital market around the world, which is really exciting for all of us because, as Kim said, it opens the aperture of where we can get diversification. And again, I would end with China is going to be, at some point, the largest equity market in the world. And so geopolitics aside, there's either still great companies, and we're the #1 equity trader in the world, and a huge amount of that sort of volume is happening outside the U.S., as an example.
Let's ask a question. This is not political. I just want to go down the line and ask you all, back to the U.S. economy, if you could ask the administration to do just one thing to keep the U.S. economy healthy, what would be the thing? Oh, dear administration. I'm going to ask you, who wants to go first? Anybody? One thing.
Don't fire the chief of the Federal Reserve.
Okay, that's a good answer.
Yeah.
Anybody else?
Yeah.
Rick.
Oh, sorry. No, come on.
I would say that the crown jewel of the United States is our innovation, and that means both the research and development we've done, as well as our universities and our venture capital community. And I would say, make sure that you protect that at all costs, because that's our differentiation. And so any actions being taken that fraught that. I heard a statistics that 98%, at this conference, 98% of drugs started as NIH grants. I also heard that Europe is trying to entice researchers and professors by giving grants, and people are taking them up on that, so that innovation could be leaving the United States, and I think that would be a really painful thing for us. So I would say protect innovation and research at all costs.
Rick?
I mean, to me, you know, we've watched the dilution of the reserve currency status, United States, and you're watching gold and you're watching the chipping away the reserve currency. And if you said to me one thing, how do you abrogate that dynamic from continuing? Because the U.S. benefits tremendously from reserve currency status in so many ways. We got to get at the spending, and we got to reduce the debt. We roll, and I talk about too much in the media, we roll over $573 billion a week of debt. That's like rolling Australia every single week. It's too big. And I've heard people say we've always had a lot of debt. Actually, we've never had our debt service explode higher, so that it's taking up all our fiscal flexibility this quickly. And countries are reducing the amount of treasury debt they hold. And I think it's a really dangerous paradigm. And there's so many, we talked about on this panel, there's so many creative ways for the government to finance.
Yes.
We've got to finance, and I think people like Scott Bessent is brilliant around this. Creative financing, reduce the spending, and create, solidify the confidence in the country so that the reserve currency, so we don't have a potential persistent pressure on the currency. And to me, that is a big, because if you leave the country to what it can do, and we talked about it, the country will be fine. And it's been able to withstand so many pressures. That's the one that I think can create a shock effect that can be very dangerous.
Kamal?
If I had to give them just one word, I would give them clarity, but let me just give you a little bit more. I think the one superpower that US has, and I don't think we will ever lose, is we are probably one of the most entrepreneurial nations on planet Earth. You know, we work with a lot of small businesses, and the core of our country sits, and if you think about it, you know, being an entrepreneur means you take risk. You know, you're willing to bet a lot for progress, for success, and the thing that allows you to do that is some framework, policy framework, that's clear. Because you are already taking so much risk. If you have bounded conditions and clarity on policy, and I could pick any policy, you could pick tax policy. If you go there, we will turbocharge this economy, because that is the one thing we have, and that creates tremendous leverage in the United States.
As an entrepreneur,
I think just to add on what Rick was saying,
yeah.
I think that you know, this administration came into office with some very, very ambitious, you know, objectives, and you know, I would encourage the administration to stick to it. And you know, anything that's worth achieving is difficult. And you know, we're in an environment right now where there's a lot of resistance. You know, but cutting that deficit and you know, not passing on you know, $36 trillion or $40 trillion worth of debt to our grandchildren is, you know, I think imperative, and to stop abusing the, you know, reserve currency status of the country, I think is important as well.
Dan, you get the one last thing.
I would say the importance of telling a story and communicating. And so I think Secretary Bessent yesterday,
They need a PR firm.
they should hire you. You know, I think Secretary Bessent pulled some of it together. I think to Tony's point and to Rick's point, you know, the deficit and some of the other things they're doing. And again, there's going to be some clearly some transactional element to this administration. But if they can pull together what they're trying to do in fiscal, what they're trying to do on deregulation, what they're trying to do around reindustrializing, and just tell the story, it's really important both to the American public, I think politically, and around, you know, staying the course if that's what they want to do, but also to the investment community. It's really important.
All right. So your son or daughter comes to you and says, I want to be in asset management. What advice do you give them? Where should they concentrate? What should they do? Should they not go into asset management? What would you tell your son or daughter? Kim, you have a daughter.
I have two daughters. Neither one of them interested in the asset management industry. It feels like perhaps I did it wrong, and it wasn't attractive to them. But I do think that there is what I would recommend to a young person now, because we know that AI is coming, and so a lot of the base skills can be done by a machine. But the differentiation is being able to ask the good question. It's being intellectually curious, being not so focused on one thing, but being a global thinker. I think if you're not that, you're not going to be able to be successful, because it's not everything's interrelated, and no asset class, no sector is not going to be touched by technology. And so you better be a more global thinker, and you better be able to ask, you have to ask the AI the right question,
Right.
and in order to get the good answer. And so I think I would encourage them to get a good quality liberal arts education and take some engineering courses.
Okay, Tony, you've got a son going to college in the fall, right?
He's already in college.
Oh,
right
he's
now.
already there.
Yeah,
Okay.
he's already there. Yeah. So I would tell what I tell young kids all the time is to, to focus on something that they love, right? You got to get up in the morning. You want to, go and contribute. And if you're forcing it, and you don't really enjoy what you're doing, then you're never going to be successful. So you got to find a passion that's inside of you. And then be a part of a growing organization. It's so much easier to progress through an organization if that organization is growing, and there are opportunities that just pop up because the company is growing. I think of, myself. I try to work myself out of a job and free up time, create a pathway for others within the organization to fill into lanes. Which I think is gratifying and is really how businesses have been able to, to grow and build and succeed over time.
Rick, what do you tell your kid?
I have two daughters as well, and they went down the marketing path, find finance incredibly boring. So, by the way, I've never been to the conference before, and as I was walking through, and I was thinking, conferences is a pretty good business to get into.
Hell yeah, ask Sarah how much this conference raised this time around. I won't leak the number, but it's big.
So, by the way, I think the world of ETFs, and what has happened is I think beta for the foreseeable future is for free. That you can get beta in different markets, you can attach to different marketplaces, and that is for free, basically. I think there's going to be two ends of the spectrum that I think are going to be incredibly exciting for many years to come. I think what Kim said, listen, I think attaching yourself to how AI and how innovation and technology, I think the world 2 years from now is going to be unbelievably different than it is today. And attaching yourself to that on the asset management side in so many different ways, or portfolio constructions, signal oriented, there's so many things. And then I think the other side of it is origination, sourcing, and creative financing, I think, is the other side. To me, are the two ends of the spectrum that I think are pretty exciting.
Great answer. Kamal.
So I have a son and daughter, and the simple answer I'll give you is, yes, they should go in asset management, but they should go in sales. And here's the reason. When you're a young person, you are very long on optimism, and you're very short on experience.
That's so true.
And sales is just the best way to get that into balance.
So true. I love
And
that.
I'll tell you why. And it's even
That's
true,
great.
more true in modern times. So to become long on experience, in sales, you will interact with clients. And clients will accelerate your learning more than your own company will. You will learn more from when you engage with clients, and your curve to get experience will go faster. And then, because you're so long optimism, your ability to take no's is enormous.
Totally.
Hundreds of no's will come your way. And I tell this to our sales team all the time, but as a young person, you will ignore it because you'll wait for that yes. And so that's more wonderful. But even in the more modern times, I see this with a lot of young people I mentor, we live in a time and era where you don't hear a lot of no's. We raise kids who, either through a parent, through the school system, university system, no's are at a deficit. So we need to encourage young people to go through the process of no's because they'll really appreciate the yes.
Oh my
But that
God.
would be my advice.
Oh, I started my business in my 20s, and I hit my 10,000-hour rule of no's very early,
Yeah.
and I didn't care.
It made you so
Because
successful.
I was like, I'd just bang my head against the wall
Yeah.
a million times. Dan,
So I have two daughters, and the first one never considered finance at all. So that's back to the Tony about a point around you go where do you enjoy and what do you find interesting. The second one, I think, followed the model of several people on this panel in that she was a liberal arts major, and this is a plug for a group that's represented in this room, Girls Who Invest. And she,
Yay.
right, wow. And then became a credit investor, and I think, and really enjoys it, and in some part does it with some origination added into it. So that, it's really cool. But I have another family member to the point around sales or solutions. A lot of the world, we love to wake up every day and be an investor and be in the markets. But increasingly, especially associated with wealth management, the solution and ease of use and how do you package it, as we discussed earlier, is really critical. So if you put that and you combine it with real alpha generation, and maybe some of that alpha generation is origination, but that first part, how do you put it all together and how do you solve problems, is also something one of my relatives does at a really young age. And then finally, I think Ken Griffin is speaking tomorrow, and he's an incredible alpha generator. But I think one thing he's on is always sell. Learn how to always sell. And if whoever's interviewing tomorrow, one of the reasons he says it is because you get a lot of no's. And then you learn how to deal with that in all of your life. And I think you can turn some of those no's into being a great investor as well, which we have several on the panel.
So just to get another layer deeper in humanity, I'm going to have my last question. I hope you all get to answer it. So it's one of my favorite questions to ask. Where were you in the birth order of your siblings, and how did it affect your life and career, Kim Liu?
So I am a firstborn, and no one is surprised by that. So firstborns, one, they tend to be rule followers, and I think not as great as taking those no's. My little brother, on the other hand, we had very different strategies. I was like, do a lot of research, figure out what I needed to do to convince my parents to do the thing that I wanted to do. My brother was asked for 1 billion things because one of them I'm going to get, right? And I think that different strategies both worked in different ways. But I think this idea of you are responsible for the people that come behind you is very powerful in my life, and I think it's born out of the fact that I am a firstborn.
Rick, what was your birth order?
I was first, and my brother is a doctor, and my sister is a lawyer. And I'll say one thing about, we sit at the Thanksgiving table, and I say, my mom says, "How are things going?" I say, "Oh my God, the stress and the markets." And then my brother's a cardiologist, said, "Yeah, I had somebody die on the table." And I thought, what we do, it's an honor to do what we do, and it's you shouldn't take it that seriously. We're trying, our stomachs churn every day about, at the end of the day, he's saving lives, and at the end of the day, there's a lot of important pursuits out there that are beyond, figuring out if the 10-year note's going up or down 10 basis points.
It's a very good point. Tony, where were you in the birth
I
order?
was, I'm the oldest.
Okay. God, lots of oldest
What's that?
children here.
Yeah.
And I have a younger brother. I'm the oldest. How has it impacted me? That's a lot of what Kim said. I mean, I think you gotta set a good example. I think that I have been, especially younger. As I was younger, I was a bit of a rule follower. I wanted to, achieve and do and make my parents proud.
So interesting, Dan.
Yeah.
I'm the oldest as well.
Oh my gosh, this is amazing market research.
Terrible here. And it's funny, I really started reflecting on this as the question got asked, but in the case of what Kim said, I in my role in the last I've been at Morgan Stanley 34 years, but in my role, I take a lot of intraday or even intra-week market risk, big market risk. But I've been at the same firm for 34 years. So there's some element of, following directions and staying steady or stable that I think is, associated with being the elder child.
Kamal, are you going to make us a 5 out of 5 or no?
Do you want to take a guess?
I don't know.
It's almost scary. I'm the oldest of 3.
Oh my gosh! Wow! I didn't mean this to come.
No, it's now we should write a book on this.
Yeah.
I've found as a parent, it's easier to father my oldest son.
Yeah. Is it?
Yeah, and he can help with the younger two.
Yeah.
Right.
Yeah.
So probably the 2 things, just to your question, what did it teach me? I think probably the 2 things it taught me. One was, I think, just listening. I think when you're the oldest, whether it's your own parents or your younger siblings, somebody's talking to you. Either your parents are telling you what you should do or not do so that, you're a role model, or others are, and just intuitively you become a little bit better at listening, because you have to process and sort of either give it back or manage it. The other thing, which is sort of unconscious, you do become somewhat of you back up people more. So I had 2 younger brothers, and who generally were getting into trouble. And I always felt like I should go back them up, take the front line for them. And in some weird way, I think it makes you a better leader. If you can back people up on their faults and their mistakes. And I feel like it's sort of, I was taught that just being where I was in the family structure.
And to close it out with
I will say that, let me say this
5
one thing.
seconds. What's that?
I just saw a meme that I sent to my brother. It said, Mother's Day and Father's Day is coming. Buy a present for your oldest siblings because they helped raise you.
Oh, how perfect. And I'll just close this out and say I was also the oldest.
Wow.
So we're 6 out of 6. Thank you all for coming. We appreciate you. I hope this was interesting. All of the oldest siblings, thank you. All right. Thank you.
Thank you.
We can go at that.